Welcome to Compound Insights, a podcast with CFA Society New York. I'm your host, Rob Rowan. Today we're discussing the details around asset allocation to alternative investments and managed futures. Today we're talking with John Twomey, Director of Research at Abbey Capital. John has been with Abbey since 2009, and he is a graduate of University College Cork. So John, welcome to the podcast.
Thanks for having me, Rob.
So I'd like to start with talking about something that your firm has a lot of experience in, and that is managed futures. How do you view the proper structuring of portfolios that use managed futures in this realm?
Thanks, Rob. It's a great question, and I think a really a good place to start our discussion. I think from our perspective to begin with, it's good to think about the role something like managed futures can play in a portfolio. And that role, in our opinion, is very much defined by some of the key characteristics of the strategy. And when I think about those characteristics, I think about three things in particular. One is diversification, or the potential to provide diversification to a portfolio, the potential to provide liquidity to a portfolio, and finally, scalability and availability of the strategy and the asset class in a more general sense. So taking each of those in order, maybe in speaking about them, diversification, and what do we mean by diversification in the portfolio context? I think anyone who might be broadly familiar with managed futures probably has seen studies or white papers showing historically that the returns of managed futures have been pretty lowly correlated to traditional assets such as equities and bonds, which obviously make up a very large portion of the average investor's portfolio. However, the other side of that, which is probably less people are probably less aware of, is also that they tend to have pretty low correlation to other alternative asset classes as well, whether those be private markets or other hedge fund strategies in a more traditional and broader hedge fund space. So the other characteristic that people often think about when they think about diversification is not just a low correlation, but the timing of those returns and when they could be valuable to your portfolio. Again, historically, this has been particularly evident for managed futures in periods of market stress, the likes of the dot-com bubble, for example, the GFC, or more recently in periods like 2022, where we had obviously some more equity volatility in the landscape. And in our experience, it's pretty rare to find an asset like this that can potentially be added to a portfolio and lower the volatility in the long run, not just to your traditional portfolio, but also to your wider alternatives as well. And from our perspective, I suppose, why is that, right? So why is it? Why does it end up like that? Why does it provide that diversification? And I suppose if it has done historically, is there a reason that it might do in the future as well? So I think that comes to the reasons why it's able or has done that historically, and two factors from our perspective tend to drive that. One is the very nature of futures contracts themselves. They possess both a long and a short side to them, which enables anybody trading the market to be bidirectional in their exposure, to potentially take advantage of trends to the upside in markets, or also to the downside. So, for example, being short equities and taking advantage of a bear market, or vice versa, being long fixed income and taking advantage of a bull market in that particular space. The other thing that tends to be a characteristic of CTAs in the managed future space is an unbiased approach. So looking at it with a potential to go both long and short, rather than just a long only lens from that perspective. And related to that factor is kind of the breadth of contracts that are traded and the type of contracts that these managers tend to trade, which is very broad. And obviously, when you're thinking about traditional equity strategies, there's a broad spectrum of regional exposure, or even kind of types of risk premium people might be trying to express in equities. I think the CTA and managed futures world is just a different view, and because it tends to be much more macro in its view. It's macro instruments that people are trading in this space. So things like equity futures on equity indices like the S&P 500, the FTSE 100, or any global index, rather than the underlying constituent stocks. And that breadth extends far beyond just equities into global government debt futures, currency futures, both G10 and emerging market, and very importantly, and where CTAs got their name from originally, the commodity market, right, which might or may not make up a part of people's wider portfolios. So the breadth that exists there is also quite large. So we move from contracts which people are familiar with, like crude oil, natural gas, things like that, to things which are a little bit more exotic or you might not have thought about from an investment portfolio's perspective. Orange juice, electricity, iron ore, things like that, right? Which are not traditionally thought of as kind of part of a investment portfolio. So those two underlying factors, the breadth of the contracts, macro instruments, and the bidirectionality, I think are two of the reasons that diversification has occurred historically and gives it the potential to occur in the future.
Yeah, I think these are two of the reasons that I was particularly interested in speaking with you about this now. Is there first off, there are some uncertainties around the private equity and the private markets globally. In fact, a couple of days, 2 days after this podcast drops, we're going to have a program at CFA Society New York that asks the question about which direction the private markets are going. We're going to have an academic and two asset owners and some GPs talking about that. The other reason is for the wealth managers who listen to this podcast. Many of them have seen a little bit of, and many of them have let a little bit of skew happen in the portfolios that they manage for people because in the last 2 years of the rise of the gold trust. The gold ETFs were an easy way to do that, but many of them appreciated a little bit higher than people necessarily wanted to in their asset allocation. So that's why I was keen to talk with you about these diversification issues now, because it is gaining in importance.
So from our perspective, again, it's about the opportunity that presents itself to these strategies at the time, right? So they are reactive to the opportunity set at a point in time. So again, if we do start to see trends occurring in something like the precious metal complex, which you described there, those are where managers will start to put on positions potentially. But at the same time, if those aren't existent, there'll be other places where those trends exhibit themselves. And that's been our experience historically over time, is that sectors and groups of contracts go through periods which they don't have a lot of trends in them. Commodities for the last decade had a particular period where there wasn't any major trends, and then we move forward into kind of this decade, and there's a lot more trends going on in commodities, which you can clearly see and have been seen historically. So building on kind of that point around diversification, the other thing I think is important to think about as part of the role of managed futures is that liquidity point around it. So again, it comes back to the nature of the underlying exposures. So done through futures, which are typically on centralized exchanges. So you're able to get very transparent pricing. Valuation is relatively simple compared to maybe some other assets. And the other thing is it's done on margin. So, that typically the amount of free cash or cash available after margin has been placed at the exchange and your brokers and your counterparties is somewhere between 75 and 90% in our experience of the AUM that a manager is managing. So it's a very large proportion of the overall capital that you would deploy is in cash or cash-like instruments, whether that be deposits or short-dated treasuries or some form of money management vehicle. So if there ever is redemptions or the need to return your capital, it should be accessible pretty quickly from that perspective. So from an investor's perspective, again, if there is potential in your wider portfolio to need liquidity, managed futures is potentially a space that has the flexibility to deliver some of that liquidity just because of the nature of the cash pool it has underneath the exposures. And the final point I kind of wanted to make around the role of managed futures in the portfolio is kind of that last one, scalability and availability. So I think that's important as well. So you want something that, if from our perspective, you want to add something to your portfolio, you want it to be able to make somewhat of an impact. And having a very small allocation to it means it may not. So I think it's the scalability and the ability to deploy enough capital into the space is important. And despite having grown in the last few years, it's still a relatively small space in the broader, even alternative landscape, and the other aspect that is there is that the strategies tend to be more medium to longer term macro type directional strategies that managers tend to deploy, and rather than kind of the more highly capacity constrained arbitrage strategies, which may be deployed in other spaces. So that lends itself to kind of the ability to scale and potentially take more assets in a wider context in the future. So the availability is also quite broad for the space from a portfolio perspective. Traditionally, and when I started, it was more accessible through private structures and private funds, offshore vehicles. Over time, that's diversified quite significantly, and now you can access managed futures still through those vehicles, but also through the likes of liquid alternatives, mutual funds, ETFs, and so on. So it has the ability to impact a wider range of portfolios perhaps than it had in the past. So
Yeah, it's exceptionally broad now. It's definitely gone through the transition that everything else has through the ETF and world that the we just last week on the podcast talked through someone who went through the difficulty and survived of converting an active ETF or an active mutual fund into an active ETF. So it's happening all over the place. So,
yeah, so it's a broad access point, I think. So if I suppose again, when you're thinking about everyone's portfolio is unique, everyone's portfolio is going to be different, but you have these common factors which could be useful to their portfolio, and then it's about access and being able to scale it in an effective way. And I think that's the way we view its kind of role in the portfolio. And I suppose then the next question you often get to is kind of sizing in a portfolio context, and that's going to be very individual to an investor and going to be related to the role you want it to play, as I described earlier. But what we see, what we feel ourselves when we talk to investors in a broader sense, is that we think it's valuable to have it big enough to move the needle in your portfolio, so that it isn't a very, very tiny part of the portfolio, but not so big that you can't hold it through the drawdowns, because that diversification, which we talked about earlier, which is potentially valuable to your portfolio, will mean that it's potentially zigging while everything else is zagging, right? So it's going to have a slightly different profile, potentially, and a timing of its poor period of performance relative to other assets. So you have to be comfortable with it so that it isn't too big a part of your portfolio that you're not going to remove it at that point and potentially miss out on the benefits over the long term. So that's kind of our high level view on kind of sizing.
I can feel pretty confident in saying this, that the listeners to this podcast who had to sweat through the efficient frontier during levels 1, 2, and yeah, level 3 probably also, um, are exceptionally comfortable with the idea of the zigging and the zagging. So, but they also are keenly focused on my next question for you, which is, let's talk about the risk factors now. You all have been doing this for much longer and have much broader experience than most. So this is sort of the thing I was very interested in hearing from you about is how do you view the risks over time outside of the asset allocation, just thinking Zach?
Yeah, I think when I think about risk factors for the managed future space, I think about it from an investor's perspective, and I think what people mean by it are two things when they're looking at the managed future space, investors' experience in particular. And those are the high dispersion between managers' returns that we see often, and the low persistence of outperformance of individual managers despite a kind of a long-term, attractive profile. So when we think about that, maybe taking the first one, the high dispersion, what am I talking about there? The conundrum a little bit is that you have high dispersion, so that is between the best and the worst managers, or the best group of managers and the worst group of managers on a given window. a high absolute level of dispersion, but you also have high correlation potentially between these managers. So in our experience, that could be as high as 0.8, for a group of say trend followers. So, you can have very significant differences in their return for a period. We'll use a year or an annual window, for example, but very high correlation. That could be as extreme as one manager being negative for a given year, while the majority of the space or a lot of their peers are strongly positive, right? So when you're an investor coming to the space, that's a challenge, a factor, risk factor you have to take into account, that there is this high level of dispersion that is there. In our experience, the main drivers of that and why it occurs over time are twofold. One is the trading time frame that the manager trades over, right? So what time frame do they use in their various lookbacks that form their view of the market going forward, but also then how they allocate risk to the market sectors. So whether you're a little bit more financial focused, trading more equity indices and government bonds, or you have maybe a bit more history in commodity markets and you trade a bit more crude oil or natural gas or iron or orange juice, as we spoke about earlier. And you have these two axes which managers are operating under. And over a given window, what's going on, where the trends are occurring in a global context will have a big bearing on who performs pretty well or not in that particular environment. So that's despite over the long term, in our experience, a very similar long-term risk-adjusted return from two managers. So just take, for example, one who is a short-term manager or shorter-term manager trading maybe predominantly equity indices and government bonds, and another much longer term manager trading the commodity sector more heavily. Well, over time, in our experience, those might have the same expected return, but over a given window, you can have quite different outcomes depending on what's going on. Whether you get, for example, I'm not sure you might be familiar with, but there's been big moves in markets like cocoa this year, right? So been huge moves in that commodity market. As a result of that, what you see is a potential for gains to be generated by those managers in that space. So that, again, next year, you don't know where the potential trend is, but it could be in a different space. So from that perspective, I think that dispersion is an important factor that people should be aware of when they're coming to the managed future space. The other one is the persistence, which I mentioned at the start, or what I mean by that is low level of persistent outperformance by a single manager or group of managers. So,
Right. This is one of those things that I never know where you're supposed to call it persistence or lack of persistence.
it depends which way you frame it, right, Rob?
Yeah.
So, I think kind of the easiest way to visualize this from our perspective, and something we've done historically ourselves internally, is you can do a pretty simple experiment. You can rank all the constituents of a given index, a given CTA index, for example, each year, right? So each year is an individual ranking. And what you'll see is that you'll rarely see a single manager at the top or even the bottom for an extended period of time, even with the same group of managers over time. And what will typically happen is it'll be quite evenly distributed. Again, because they've all made slightly different decisions on those two axes we talked about earlier, the time frame and the market sector. And in general, there are other reasons that drive these kind of factors. Whether your choice of trading rule, right? Whether you're using moving averages or breakouts if you're a trend follower, or whether you're targeting volatility at the portfolio level or the contract level or at all. So there are other factors, but in the majority, in our experience, those two kind of factors of kind of the time frame and the market sector do drive a lot of what goes on from a risk factor perspective. And I suppose it also plays into our idea of what the best approach is to kind of addressing that, which is it's probably makes sense to have a portfolio-based approach. And certainly that's our approach to it, rather than having a single manager, that there are benefits or potentially benefits to having a portfolio of managers that make up your managed futures allocation. And that very much underpins our own approach, which is a multi-manager approach.
Yeah, that's what I was gonna say, is that if this sounds like John's been bruised a couple times to those of you on the podcast, it's because he has, because they run a manager of managers program. So, uh, so I just wanted to make sure people frame that. So let's get under the hood of your manager of managers program, see how you do this.
Yeah, of course. I think it's always good to start with by taking a high level view of what's our philosophy and then the philosophical perspective the investment philosophy we come from. And our core belief is that there's no perfect solution out there, but there are still a lot of very smart people or very smart teams who have developed parts of the answer. And each of them in their own right is a good standalone program. But combining these approaches together in a portfolio and then properly sizing it for the risk level you want to have gives a result which potentially has the ability to be a little bit more than the sum of its parts. So to phrase it another way, combining different trading styles, timeframes, and even things like principal backgrounds, geographical backgrounds, things like that, and approaches has the potential to, in a portfolio, to potentially reduce your drawdown and potentially improve the overall risk-adjusted return of the portfolio. So that's kind of our first thesis, particularly when it comes to something like managed futures, which has that, in our opinion, the high dispersion and low persistence of kind of outperformance.
Right. So I guess the question I'm sort of exceptionally interested in hearing about is, given the dispersion and the low persistence, if you're running a manager or managers program, how do you decide when to leave a manager?
A great question. And I think some of our approach comes into that as well. So one of the ways we implement our multi-manager program is that we do it through a managed account platform, our own internal managed accounts. So what we do there is, rather than investing through a manager's fund vehicle, we ourselves will set up a managed account, which they will be the trading advisor on. So it creates a few key distinct differences for us in terms of our overall portfolio, but in particular, to answer your question in terms of our ability to understand the manager and decide how to stick with them or not. In terms of just general, I suppose, attributes which we think are useful to running a multi-manager program, it has a lot of efficiency. We have a large pool of capital, and we're negotiating on behalf of that large pool of assets, clearing costs, administrator fees, manager fees, and so on. We also maintain custody of the cash, so we're not passing the cash to the manager. They only have authority to execute trades on behalf of the managed account, and have so you're at risk of things like, again, something happening outside your control around cash movements or fraud or something like that has been reduced potentially. We manage all of that in-house ourselves. But the most important part to your question is that transparency that something like managed accounts gives us. So because the managers are trading on those managed accounts, we're able to see every single trade that they do. So again, we'll have set up a very strong expectation around what the manager program is designed to do, what contracts they're able to trade, all those various components of it. And that by getting that trade level information, which we get daily, and it's available to us on T+1, which is, from our perspective, more than 20,000 trades a day that our back office process on behalf of our entire group of funds that we support. What that allows us to do is very granularly assess whether the manager is in line with the style that we set for them. And that's particularly important for us. Again, if we set out a manager to be, I suppose, we believe they are a long-term commodity-focused manager, and there are trends in commodities and they're not turning up in that environment, well, what's going on? And you can use a managed account potentially to drill down into their actual positioning. Is it commensurate with what you expected for that manager? or is there an element of style drift or inconsistency going on? And that's would be a key concern for us in terms of potentially removing a manager from our portfolio. So yeah, that transparency allows you then to kind of particularly target something like style drift, but also get an understanding as well of why a manager might be underperforming. So the support that the managed account gives you will help you in running that program.
Well, and naturally going sort of to the other end of the bus, if you will, being able to assign style, understanding what style drift is, starts with understanding what trends you expect to to go on there. So, could you take us to the trends that you all are seeing in this area now?
Yeah, I suppose at a high level, when we think about trends, we don't think about predicting trends, right? We don't think about that's not what we do, and to a certain extent, it's not what the managers underlying the portfolios is. They're reacting to whatever the opportunity is at a point in time. So we'll never give a prediction that there'll be trends in a certain space in the future. What we can say is that when we build our portfolios, we try to build them in a way that potentially captures a wide set of opportunities. So when I kind of think about that question, it comes back to kind of our kind of investment philosophy and how we think about kind of capturing or investing in trends in a wider sense. And the first to build on what I said earlier, which we talked about kind of our belief in that multi-manager approach. Within that multi-manager approach, we believe trend following in particular is a very important part of our portfolios and a very dominant return stream in the managed future space. And it produces a very robust engine for the portfolio. But to be successful in investing in these strategies, there are a few things that we feel that are useful for us to do in terms of it. The first one is very much that portfolio-based approach we mentioned earlier. The second is to diversify across the time frame and asset class spectrum, right? To make sure that even if you have a portfolio of managers available to you, that they are differentiated. And that's, again, our view, you could have a portfolio, but everyone's very similar. Well, there are these degrees of freedom you're able to look across and try to ensure that they are quite different from each other, that you're capturing the full opportunity set as best you possibly can. The other thing from our perspective is to take quite a long-term approach. So as I said earlier, the zigging and the zagging, well,
Over
that
the long
also
term, that kind of weeds itself out, right? Yeah,
exactly.
yeah.
But at the same time, you have to be able to live with managers in a portfolio context. So the same thing I was talking about earlier in a wider portfolio context of, say, traditional assets and other alternatives where managed futures exist, well, the same kind of thing exists at our kind of portfolio level of a portfolio of managed futures managers. So again, we have to ensure we understood why we hired a manager for their role in the portfolio. And then if the opportunity set is poor for them, well, that's just kind of the part of it, and we have to live with it through that drawdown. However, if something is broken and we need to change, we need to react to that. So the key thing is knowing why you added them to the portfolio and what the context of the environment is around them for that. And the last point, I think, in terms of successfully, from our perspective anyway, how we go about it is, harvesting kind of that trend investment, as you said earlier, is to consistently allocate risk. So in our experience, again, it's very difficult to time the space. And in our experience, it's better to have a long-term risk allocation to the space because it can be very difficult to figure out whether it's a good environment in the next 6 months for trend following or not. So you don't know when or where the trends will occur, but over time they will. And consistently allocating risk is kind of one of our key philosophies.
Well, one of the things that I was thinking about when you started this, because I don't pretend to be super deep in the managed futures world at all. The way you explain it, the approach you have to this, is sort of traditional investing. Right? It should feel very germane to any CFA charter holder out there because we studied it so darn much. So, well, thank you, John. This has like been a really great explanation of these things, and I thank you very much for sharing your experience with it because you all have a lot more than most.
Thank you very much, and thank you for having us.
And thank you all for listening to this podcast. If you'd like to find more about John, he is findable on the internet. If you'd like more about Abbey Capital, I would encourage you to take a look at their website. Until next time, this has been Compound Insights, and I again am your host, Rob Rowan.